Margolin from Wolfe Research. Sam, does this change the thesis, the case around Exxon?
I mean, I wouldn't say so. I think Mr. Rubin made a point in that clip that, you could attribute the underperformance in Exxon to a lack of an ESG strategy or one that the market's not underwriting. You could also attribute it to the fact that oil prices went negative last year. And so I think, there's a lot of cross currents involved, but one thing that is intuitive is that if they did have a more firm strategy around ESG, it couldn't hurt.
What does that mean? Because they would probably claim that they've been putting out lower emissions targets and putting all sorts of things in their annual report to respond to growing pressure that has now become public from a number of investors, including CalSTRS, to do more on this front. So what changes?
Well, yeah, that's a good point. I mean, I think that, one thing that has been consistent feedback from the market that we've been getting, and one thing that stands out if you cover the company for long enough, is that it has this tremendous capacity in applied sciences. And there's a lot of brilliant people that work at the company. There's a lot of PhDs. There's probably not a good reason why Exxon's not the leader in every single vertical that people associate with ESG, whether it's hydrogen or batteries or anything else, other than they just haven't seen the return there for themselves quite yet. And so, if there's an opportunity to outline those returns and communicate them to management and apply the company's capacity in this regard to some verticals that the market is really ready to sponsor and get excited about, there's probably some upside opportunity in this stock, which I think was sort of at the heart of what his initial comments were.
Is it realistic, Sam, for an ESG fund to buy Exxon on legitimate reasons rather than just because of large positions in index funds and factors like that in the next decade? Or will oil and gas still be such a big portion of earnings that these are all only going to be very small attempts to change the direction of the oil tanker, for want of a better anecdote?
Well, it could be both. I mean, look, it's very likely that there's going to be another cycle in the oil market, at least one more, over the next 10 or 20 years. Oil profits funding the energy transition or alternative energies is probably the most ESG-friendly story that's possible. Now, that's not to diminish what Exxon can accomplish in the oil and gas space, because they can still grow in that field at really high returns. But I think there's room in global energy for both. And this isn't a new issue. This is something people have been talking about for a long time. As emerging markets scale, as per capita energy consumption in these other countries gets to OECD levels, it's going to be hard to find enough traditional energy to accommodate that. Commodities are going to be scarce. And so it's going to require a lot of different solutions. It's also going to require a lot of money. And oil and gas can provide that over the long term.
Sam, thanks so much for joining us.
Thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.